Hello, everyone. Tokenized assets are gaining attention across retail and institutional markets. But while the opportunity is clear, the path to adoption is not the same for everyone. This session gathers builders and industry experts to discuss the key issues around infrastructure, ownership, and settlement that will shape the next stage of innovation. Welcome our moderator, David Jenkins from Open Markets Group, back to the stage. And please join me in welcoming him and the panelists with a round of applause.
Thank you, everyone. This should be a really interesting session. We're going to focus this session on tokenization and the uptake of tokenization generally. We've had talk of tokenization being trillions of dollars in market size. We don't quite see that adoption yet, probably more in the billions, but we're here today to talk about what are the structural impediments stopping it from growing and what's the future direction. So what I'll do first is, if I could just ask each person to briefly do an intro and just what is your angle on tokenization, if you wouldn't mind starting us off?
Good afternoon. My name is Chris, work for CMC Markets. Tokenization has not taken off at all in the world I sit in. It should have done, but has not. Now, to some extent, a CFD, which is primarily what CMC offers, to be honest, that is a token. It's a fractionalized real-world asset. That's all a token is, and that's all a CFD is. CFD in a token is a settlement vehicle, and it's infrastructure. Okay? So part of the reason I don't think tokenization has taken off is, one, we already have it in a fungible way. The main reason it's not taken off in what we see is regulation from MAS, Hong Kong, Dubai. It's not clear what the rules are and are not. It's also not clear, especially on the crypto side, how you fund via blockchain into the banking system. I don't think the banks want and or are ready for tokenization. And the cost of tokenization is not sufficient yet that it makes sense in what is a tradition, in a TradFi world, even today.
Let the other panelists introduce themselves. And
so my name's Justin Christopher. I'm the local MD and look after Calistone. So we are infrastructure, and we help our clients actually start their journey of tokenization. And we probably have a slightly different view to you, Chris. I mean, we're starting to see people do this more. But again, let's keep in mind, to Chris's point, it is a settlement vehicle. But I mean, the whole point of going to digital is to fractionalize, is to be able to get onto that decentralized finance, whilst getting more efficiency, quicker settlements, while still also getting those regulatory protections that we have in place today.
My name's Jeff Zhao, and I'm head of ecosystem at DGFT. So we are a dual licensed decentralized exchange under the license of MAS and SFC in Hong Kong. So from our seating, the tokenization is pretty straightforward, and our mission is pretty straightforward. So we bring the regulated off-chain asset managers to on-chain capital, and also enable on-chain capital to have access to yield-bearing off-chain revenue streams.
Hi everyone, I'm Lini from Partisia. The fundamental rule of is you should never, ever surrender your data to your competitors. So tokenization automates value, but without privacy, infrastructure, it's not, calling it an upgrade. It is a corporate liability. So at Partisia, we are building a cryptography infrastructure that allow banks and institutions to settle on a shared ledger without ever share their data.
thank you very much. It's an incredibly diverse viewpoint that we've got coming into tokenization as a topic. I might direct my first question to you, Justin, if you don't mind. And that is, as a true bridge, Calistone offers a bridge between TradFi and the digital asset world. And with your tokenization network that you're moving into, where do you actually see the adoption today? Like, if we focus on the digital asset side, do you actually see uptake there, and are people actually allocating to those products?
Yeah, no, good question. So I mean, if you think about the journey we've been on, I mean, every year when we go to the FinTech Festival, even here, there seems to be a different focus and a different way in which people are starting to look at it. And more recently, it's been very much money market fund based, and really trying to get the distributing power out there and trying to get that money coming in has been the challenge. We've launched the Tokenized distribution network, and again, that is very much to enhance fund managers' reach and to grow their AUM. We have seen an uptake. Has it bent the curve or really taken off? Not yet, but then we didn't expect it to. I mean, we're probably a decade away from this really having some large value, which I'm sure we'll get to later. But when we start to look at some of our clients, if I take one out of the UK we have at the moment, they've put 50 billion worth of money market funds onto the network. So you can go and transact today. It is available there today. Again, if I look more regionally here, we've worked with one of the global security services providers. They're live in Hong Kong. They're tokenizing products there. So it started. Is the dollar value or even the transactional value where we thought it would be? Absolutely not. But again, we've all got to start somewhere. I mean, we can see on the network today, I mean, we roughly have around 300 billion month for month coming onto the network. So again, even if we can only get to just 10% of that over the next 12 to 18 months, that's going to be a huge sort of footstep forward than where we are today.
Yeah, it surely takes some time to actually get some of the processes off the old way of doing things as well when it comes to digital assets, for sure. I mean, I'd be very interested in your perspective, Jeff, on being a regulated entity, an issuer of tokens, and probably focus a little bit more on novel products than money market funds and mutual funds. Can you give me your take on adoption, given you've got quite a lot of products out there?
Yeah, so DGFT starts with money market funds from the US. Why? Because we see actual pain points on chain, which is the crypto native institutions. They need treasury management solutions. So we bring our flagship product is from UBS. It's called UMint. And we also deepening the penetration through different managers. We also have money market funds assets from, say, Ultra, like Wellington, and also from some Chinese asset managers as well. So we do think the trend always start with a vanilla product at first, but we are also seeing risk is moving up on the risk curves. So people also have appetites for, say, private credit and also private, say, public equities. And we are working with asset managers to bring that on chain as well.
Yeah, it's very interesting. And moving on, Leni, so you come from a background which is more like from the network side, and you're focused on the MPC side of privacy. Can you give me a sense of what that means for issuance? Like, what are you seeing in terms of uptake?
Can you repeat that question?
Oh, I'm just interested in what you're seeing in terms of uptake from real-world assets, given that your focus is more on privacy and more on the multi-party computation part of that.
Yeah, so for us, what is live today is a decentralized identity system that we have offered for Japanese regional banks. So what we do is we use cryptography to go in and mathematically prove that a user is legitimate or an account is has enough sufficient funds without seeing underlying data. So so how do you say it? It's like verification without exposure is actually the only way I see that institutional will move forward with.
It's a very interesting take, because I think part of what you're saying there is that people won't use public available blockchains, for example, for issuance because there's that privacy issue surrounding them. Is that true?
Correct. That is correct.
Okay, thanks very much. And Jeff, so coming back to you again. So when it comes to conventional wisdom, private markets and real estate are the biggest opportunities, but is that what you're seeing in terms of adoption, or is it more around things like tokenized cash, collateral mobility, intraday repos? Like where do you see the real excitement about these products?
Just like I said before, this is more from the vanilla product first. So it's definitely on the cash management side first.
Cash management.
And also, yes, and also because of the wide adoption of the stable coins. So like people want to park their money in money market fund first. But I think the upside is definitely there. So as you said, like private, maybe some private credits and also real estate, it's getting more and more exciting.
Yeah, okay. And so Justin, in terms of tokenized assets, such as mutual funds and ETFs, I mean, maybe they sound boring, I suppose, in terms of tokenizing those products. But where do you see the unlock for an asset manager for those products? Like, is it real-time settlement? Is it greater distribution? Like, are they tapping into a different demographic by tokenizing these products?
Yeah, look, I mean, the goal isn't to make them sexier. I mean, we know what they are. Everybody uses them today. Look, there's a lot of talk over whether mutual funds will start to phase out, whether tokens are going to take over. Again, there'll be few people in this room that will still be here when the mutual fund isn't around. So there will be diversification. There will be changes to all of this. But I don't think we're going to see significant change in the short term. I mean, what tokenization does is unlock a lot of the inefficiency that we do see in the market today. And what we're trying to do is give people access to that plumbing to bring that efficiency in. If we can do that, I mean, we literally unlock trillions of dollars to where they sit today, and some of the processes where it can take you, in some funds, up to a month to get your money back. Obviously, that on-chain efficiency, very, very different. I mean, when we go out and talk to our clients, when we go and talk to the asset managers, I mean, their goal is to grow AUM. Their goal is to obviously bring new products to the market that helps them achieve that goal. Expanding investor access, simplifying the infrastructure. I mean, it all makes sense to them. I mean, but equally the market's moving, that's forcing them to look at some of these processes. As we move more to things like T+0 settlement, they've got to come up with different products. They've got to come up with different access points, as well as more digital strategies to keep investors, keeping their money with those asset managers. I mean, key to this, though, is we've got to take everybody on that journey. It's got to be everything from the broker, the planner, the regulator, the asset servicer, and they've all got very different touch points in that. And we've got to try and make sure we unlock it in a manner that just, some people are not being completely removed from the chain, or they find different ways to add value into that chain.
Yeah, it's would it be fair to say you're coming from the issuer-sponsored side of the tokenization story, whereas I'm very keen to hear from you, Chris, in terms of the CMC markets point of view, where a CFD or a perp is more like a synthetic exposure. It doesn't quite have the infrastructure issues of bringing along issuers and registries and everything else. So what's your take on adoption?
I mean, look, we've had T0 for 35 years. CFDs do not settle. So the settlement is not an issue. You can fund your CMC trading account with crypto now on the blockchain. You can buy SpaceX as a token from me now, and we have the physical underlier to hedge that. So we bought a crypto company and all the blockchain rails years ago. So we use Connexus to JP Morgan's blockchain for all of our treasury management services. So we're very much early adopters of blockchain and crypto. I think the problem we have as an institution with blockchain is that unless there's clear regulation, how do you attach leverage to a token? Because we can give you our leverage on a CFD by taking counterparty risk against CMC. How do you do that in a decentralized world that sits on a blockchain? So it's a very different thing. ESMA have come out recently and effectively banned perps, and they're called CFDs now. So I think someone like CMC or someone like a CFD player is very well positioned for tokenization and for blockchain.
Yeah, look, I can clearly see that bifurcation in the industry between perps and what I would call issuer-sponsored tokens or beneficial ownership. That there's very clear roads in either direction, and both clearly have their pros and cons and benefits as a product. So it's going to be very interesting to see how this plays out. Coming to you, Jeff. So we're going to switch gears a little bit and talk about regulation now, and just where we stand with that. Jeff, MAS regulated entity. I guess this sounds a little bit like one of those intercity type questions, but where do you think Singapore stands regionally compared to some of your peers, such as Hong Kong, Tokyo, and Australia?
So we are dual regulated. We are regulated under the MAS regime and also the FSC regime. So we are very fortunate to work with MAS back in 2022 to be in the sandbox, and also again now we're a full license in 2023. and also gained our HK license in 2025. So I think Singapore's regulatory regime or authority are very up to the speed. So they very deep into the technology and also cares a lot about investor protections while not curbing the innovation. So I don't think there's anything like on top of my head to be involved, but I would say generally in the market, the liquidity on the product and also the retail access are the two things that we are working closely with regulators in Singapore to solve, because that's basically the choke point right now.
Yeah, thank you very much. I mean, it does certainly feel like Singapore has a very mature and structured approach to this market, and hence, could be, certainly maybe a bit further along than Australia might be, let's say. Thank you for that. And so, Leni, I wanted to ask you a question around white papers versus proof of concepts. What are you actually seeing coming through as an actual product that's being issued versus like a pilot or a POC, in particular referencing works by central governments and other government entities?
Yeah, so I recently just moved to Singapore, but I have been from Hong Kong actually. So two great examples of projects, Project Guardian and Project Ensemble, are the fastest needle mover, I would say. And the reason why is that they're connecting isolated systems. So this means that systems that are isolated, they might have facing some sort of I think the reason is the mechanism of defense for this is to avoid data exposure. So, but the problem is that there is a certain, regulators want efficiency, but the problem is that strict data privacy laws forbid them in broadcasting these sensitive data. So that will create kind of like a regulatory paradox to it. So yeah, we cannot force a bank to expose client data on a public network or a shared ledger. Scaling only happens when you have an infrastructure that can do both, which means the first thing is you're staying compliant, legally compliant, of course, while you are participating in a shared network.
Yeah, that completely makes sense. And some of these central bank-sponsored initiatives very much have that in mind, and are moving at a very different set of criteria, I guess you could say, some other parts of the industry. Is that something that Partizio is involved with some of these pilots and programs?
It's still under NDA.
Oh, fair enough. Well, you can just tell the 1,000 people here. That's okay. They won't tell anyone. No problem. So moving on then. So Chris, back to you then. So from a license broker's point of view, you're obviously multi-regional. You've got a lot of exposure across the different business lines that you've got. So what do you think needs to happen for tokenized products to become bigger, to reach that $1 trillion market that people talk about?
It's not technology or infrastructure, it's the rules and regulations. The biggest thing is, let's say we have a broker with tokenized Apple. If they want to transfer that position to me, it's very easy. We do a fund transfer, stock transfer form. How do you do cross-border fund transfer in a tokenized world? How do I take my Apple stock in Singapore to Mongolia and sell it? Because each local regulation and each country has its own rules. But tokenization doesn't, it allows for that, but not in the TradFi world we live in. How do I KYC someone? How do I look at someone's source of wealth? How do I look at distribution, client suitability? The banks don't want to take our crypto money now. The custodians don't want to put tokens on the, Apple tokens. They don't want to take it out of their wealth and put it onto the blockchain. There's a whole cottage industry built around all of our jobs that tokens should have disintermediated by now, but it hasn't done. So part of it is the banks don't want it. The regulators deliberately, in my view, not making it clear what the rules are and are not, especially the travel rule. And we all don't want it to come. We want it, but we don't really want it. It's a bit like AI. And so it hasn't happened. There's no mass adoption of tokenization in any form whatsoever.
It does feel like we're taking a technology that's built to be borderless and putting very strict borders around it. That's very true. And you know that I think will force a reckoning at some point to say, well, you've got all this capital mobility, but I'm just not going to allow you to do it because of the domestic restrictions around some of those things. So it is a very, very interesting roadblock. So switching on to the roadblocks to scale, I wanted to come back to you again, Leni, on you mentioned a bit about, you know, fragmentation and about privacy. And so my question really for you is, interoperability is on everyone's mind. So when it comes to interoperability, are you seeing coalescing around certain frameworks and patterns that lead to wider adoption? I mean, you know, I don't want to bring up the kelp DAO thing, but the cross-bridge things feels like a real issue when you've got all these different blockchains that we're bringing to the table. What's your take on that that fragmentation and what we can do to solve some of it?
Okay. So I believe that, so currently it's like this. Institutions are currently operating isolated systems. This isolation is actually a defense mechanism against data exposure. Companies build private ledgers because public networks expose their data by design. So therefore, the roadblock to interoperability is that it's not really bridging the technology, but it is the fundamental principle of there's a lack of privacy. So because of that, scaling for this only happens when you establish when you have established standards that allow isolated networks to to settle without any exposure, meaning you're not sharing your data, but you're still in a shared ledger.
Okay. Yeah. I think this is some of the zero knowledge proof work that Partizia do. It's also very interesting.
Yes, it's a zero knowledge proof.
You know, I mean, I've read different things about whether or not people will end up coalescing around a winner when it comes to some of this infrastructure, or whether it will always be cross-bridge interoperability. It's an interesting dimension on that for adoption.
Yes.
So then, Justin, if I could just ask you this next question. So again, it's about roadblocks to scale, and you know, I guess my question is, how fast can really the industry move from an asset management perspective and on uptake? Like, let's say we solve some of these things, these cross-bridge portability, the privacy issues, the regulatory issues. How fast do you think adoption would happen if that were the case?
Yeah, so look, to a degree, probably going to echo a lot of what Chris has said earlier on. I mean, for us, the tech is ready, okay? We know we have the capability. To be fair, most of the asset services have all the capability. I think we've probably been a bit hard on them in the sense of they're adopting it, they're working out how to use it. I mean, you look at some of the players, HSBC, StanChart. I mean, they spent billions setting up their digital asset strategies. They've got a strong appetite to get this up and running. When we look at the regulators, I think again, we see some more advanced than others that are quite publicly saying that they're going to sit back and watch some of the more forward-thinking regulators push first and then take an adoption process afterwards. But we're not all moving at the same pace. And that's where we're kind of getting some of those sticking points. Today, and until we can solve whether, we need a registry to be in place instead of taking a record off-chain, we're going to have some of these problems all still here. When we start to look as well, I mean, we've spent a long time pushing a lot of those asset services down in terms of their costing models. That's great, and obviously that helps on returns, and, people come away feeling good that they bashed the rate card down, but the counter effect of that is they haven't been spending the money on the infrastructure to keep everything up. So now we've got an awful lot of legacy infrastructure, be it with fund administrators, custodians, TAs, that makes it very difficult to suddenly leapfrog into a digital world. And that's where they're having to spend a lot of time trying to do it. And of course, that's pure investment. They can't go back and charge it back to their clients, yet the clients are expecting them to run quickly. And again, as we touched on AI very lightly, and I don't want to go down that rabbit hole, but of course, that's where some of the AI slow adoption's been, because the legacy systems make it so hard to connect to get some of that true value back out. That said, I mean, we're definitely beyond POCs. It is live. Is it live to its full potential? No. Will it get there? Yes. You know, the market's moving that way. We are going to move away. You know, we've got to get the exchanges on board. There's a lot of parties in this chain that need to come there in order to really push it forward. But it's working. I mean, go back 3 years, we pretty much had nothing tokenized. So again, not where we want it to be, but it's slowly going.
Yeah, look, I just love what you said, that dynamic there about everyone thinks tokenization is going to be cheaper. And you know, some of the thesis always is, oh, it's going to be cheaper, but then you realize you've got all this sunk cost legacy infrastructure that needs to be renewed, and well, who's going to fund that? Can you build that into your business case?
But I mean, that's literally the nail on the head. I mean, we spend a lot of time talking to a lot of the TAs. You know, they're out and they're building digital TAs. And you sit there and go, but that's probably a 5-year project. Are we going to need a TA in 5 years? Don't know. I mean, again, that's going to be a regulatory question. But also, to your point, the minute they build that TA, they've just spent millions doing it, but the expectation will be, well, you've gone to a digital TA, surely that's cheaper than your existing TA.
Yeah, I mean, I think even this touches, I could probably even follow that up with the liquidity question, but what I might do in terms of when you have that new infrastructure and the products you put on there, are they actually bringing in the liquidity and generating the sort of demand you expected them to? You know, it's a really big question, because in some ways it's a bit of a gamble to build that out. So, Chris, this is a little bit of a derivative from what you said previously, because you touched on fragmentation, regulatory perspectives, and this domestic kind of view on that. But you know, what are some of the unlocks, do you think? Is it around KYC? Is it suitability questionnaires? I mean, what are some of the things you think might be able to unlock that type of liquidity from a different set of investor bases?
So liquidity is not an issue. You know, a CFD, as I say, is like a token. If you trade Tesla with me as a CFD or as a stock, I could put it onto a token for you today. I can put it in a cold wallet, in a hot wallet, right now. So liquidity is not the issue. It's that there's no mass market adoption for tokenization yet, outside of pure cryptos. So everyone spoke about real estate, fractionalization of real estate. In Australia, they talk about fractionalization of horse racing or horse ownership. It didn't happen. You know, at one point, everyone was talking about these fungible tokens, and I'm not talking about the apes. I'm talking about like whiskey ownership, where you could physically have your token. It trades on exchange or an exchange, but then you could take ownership of it by redeeming your token and fund it. That didn't happen. So every use case for tokenization is not really played out. It's not that the ideas weren't good. It's that the banks, the regulators, the custodians, they don't want it because they're saving their cottage industry. The best example is a bank used to have your cash, and you'd pay your bank to put your cash in their bank. And on your digital bank statement, you had a ledger that says, I've now got $10. Now there's no such thing as cash. You just have a digital ledger that says $10. It's the same with crypto. It's the same with tokenization. It's not a physical thing. It's a digital thing. But private companies do that. It doesn't need to be disintermediated or put onto a blockchain. So there's just no real world application for it as things stand today. It exists. It's like crypto, though. 10 years ago, oh, everyone will be paying with crypto. It didn't happen.
I really love that angle. It's a great angle, because I think sometimes people, we rush into this domain with the expectation of some benefit, but then finding that benefit is very slippery. But in response to that, would you have anything to add, Jeff? Because I mean, obviously this is your business, right? I mean, DigiFT is tokenization. So if tokenization isn't taking off, then what would you say to that?
I think it's very natural that you have this kind of like a grand news story when new things happen, and people had the vision that they're going to tokenize like illiquid asset like properties, and then put that on chain and say this is going to increase the efficiency a lot, right? But to Chris' point, we don't see that happen yet. What happened in the beginning is opposite of what we were thinking. It's the market fund like on chain, but it was so liquid that people can't imagine that we're going to use that on chain. But apparently that's the biggest asset class, single asset class right now. So I feel like I would definitely agree with that. And also like I think even going forward, like in 10 years time, we will still seeing the biggest asset class on chain is the money market fund and deseeding by the risk appetite. So basically, it's going to be it's going to be biggest one. It's going to be cash management, and then probably bonds, and then probably equities, and then probably real estate.
Yes, that's very insightful. I mean, cash management is definitely something that's come up earlier today. That's a real need from people to be able to fund and repatriate funds very quickly. So that's almost a given that will happen. So look, I think we've kind of got everyone's perspective. So what I might do really in closing is just kind of have closing remarks from each person in turn, if you don't mind. So, if you look back, it's 2030. You look back, and where have we gone with this? And was there something that happened that no one was expecting? So what's your forward take on where this is headed in the long run? Who's game to go first? Leni?
So by 2030, $1 trillion will be in tokenized treasuries, but that will actually go in and migrate to distributed ledgers to achieve atomic settlement. So, how do we say it? It's yet because institutions, they will never ever move any of their funds to a shared ledger because of the fact that it's exposing the data privacy, right? Data exposure. And it also not just their data privacy, but also their strategic positioning that will be visible to their competitors. So I think the first trillion settles when we have, sorry to say this, a production grade privacy that meets lowest risk asset.
It's a really great perspective because it's very true. This privacy angle is super important. And I know that people are doing workarounds like minting blocks at a time to try and hide what they're doing amongst those blocks. So it's a very, very good point.
I think 2030, we're going to have the largest AUM in definitely cash management, but probably largest trading in equity. We're probably going to trade that 24/7, and probably not matter for traders, but good story for us.
Awesome, thanks.
Yeah, look, I think we're probably all echoing the same thing. I mean, by 2030, I'd imagine there'd be $1 trillion in money market funds. I'm probably a little bit more skeptical on some of the other growth stories to that size by 2030, but certainly the money market funds will be there.
Okay, thanks very much. Chris?
Stable coins.
Yes, well, I mean, they've already proved their utility, right? So
It's the only thing that transacts on-chain. Nothing else transacts on-chain today. Of scale. Just stable coins. And this illusion that you can buy you can buy a flight or a house with Bitcoin, it's gone. It failed. Stable coins are the only thing that survived.
it's a great perspective, thank you. I really like that angle. Look, we've probably got a little bit of time up our sleeve for questions if there's any out there. I don't know if we've got a mic roaming or anything, but are there any questions someone would like to ask of this amazing group of people we've got up here? Oh, yep, here we go.
Hi, thanks for a great panel. It was very interesting, guys. I'd be interested to hear how the panel responds to some of the points that Chris raised. In particular, for example, beyond just the roadblock that, Chris, you were saying that the regulators and the banks and the existing TradFi puts in place, once upon a time, part of the argument for tokenization was fractionalization of assets. And maybe that's really of only interest to consumers, and even then, I didn't see much of it. From an institutional standpoint, one of the arguments that I had always heard was the network effect of an ecosystem. So that, for example, if I'm a bank, I might be interested in this if the tokenized assets that you bring to me have the liquidity to move around to, let's say, secondary markets, services like collateralization or liquidity pooling, things like that. Which, coming back to your point, Chris, if we're going across jurisdictional boundaries, that's very difficult today. If I'm doing it all just within Singapore, that's great, but we don't even have that kind of digital ecosystem. So, panel, I would be interested, A, do you think that there's a network effect that's missing that could be put in place? And B, I think the other thing, maybe coming back to your point, Jeff, is that there might be some new and interesting asset classes that we could bring to the table that the digital asset ecosystem would be unique to the digital asset ecosystem. Whether it's, say, something like tokenizing IP or, let's not do real estate, but there might be other stuff that we can do.
Yeah.
That would be of interest to the buy side, to the investors.
So if it's a liquidity question, like dark pools and light pools exist if you want to access blind liquidity, right? And they've been around for a long time. I think the best use case of tokenized assets, of recent tokenized assets, is, let's call it the events betting space, right? So I think there's a few of them around. Kaoshi's probably one of the bigger ones. They are one of 3 different models, right? I can see the CME here. They're building a listed version. But all of the event contracts, you can bet on the weather, you can bet on Donald Trump, etc., right? That's probably the best example of an OTC, because it is OTC, it's not on exchange, right? Token, real-world application. Now, but they're not actually tokens if you look at it. Crypto.com's got one. It's not really a token, it's an exchange. If you look at Kaoshi, they're doing it via effectively listed e-mini futures or futures. And then if you look at Polymarket, theirs is just an OTC settlement, just like fractional shares. So it's not actually a token, but it's the closest thing to it. The hardest thing comes from they're all fully paid securities effectively. There's no leverage in there. So when it comes to how do you transfer leverage from me to you, it becomes like a warrant at that point where I have to transfer that leverage to you. And then how do I transfer it in the custody market? Let's say it's Apple shares and there's a stock split or there's a dividend. How does it follow on-chain? How do we physically do that transfer? How does Apple go to every single blockchain in the world and transfer an additional 4 shares or 4p for a dividend? All of those things have not been worked out. But to come back, the event space is the closest thing, and I think it will be around for a long time, by the way. It's the closest thing to a real-world token asset that everyone will use.
I'm really disappointed I missed that prediction markets one today. That's a really exciting topic. When it comes to network effects, would you also loop into that things like capital mobility, such as being able to recollateralize your wallet for other asset purchases? Has anyone got an angle on that? Like effectively it's a use case of digital assets that's a really strong one.
If no one else, I can talk into this because you could now pledge stable coins or crypto, or look, you could put Tesla shares with me and I will give you margin. Okay, physical shares. The regulation currently is that if I take stable coin or crypto, I cannot use that as collateral because the regulator doesn't see it as collateral. It basically sees German bonds, treasuries, Swiss yen, and cash. It does not see stable coin. Because of client seg rules, I can't take your stable coin, sell it, or convert it into fiat, and then use that as collateral. But I can take your Tesla position and do the same thing. And so this is why I say the regulator is a major part or a major roadblock in everyone's push forwards. It's not us. We're ready. We rally them. We need global regulators to get onto the same page as you and I. And then I think it actually becomes a very interesting use case and scale. But without that regulatory change, we're very hamstrung because we have to do what the MAS says, or the FCA, or in Germany. But you're right, that is coming, but it's just not there yet.
Yeah, I mean it's pilots in a lot of cases. But one more question, lucky last. We've got a minute and a half. Any other folks out there want to ask a question? No, we're not going to take the opportunity.
Come on, Neil. You ask a question, Neil.
Someone must have a question there somewhere.
Neil from the CME, guys.
Can't believe everyone's so quiet. Here we go.
Thanks, Neil.
All right, just for you, Chris. So you're talking about stablecoin being the relevant tokenized asset. What's the use case for it?
We're trying to kill the CME, Neil.
And maybe the other panel members, I mean, Jeff, maybe you've got a perspective on it. You talk about cash management. How do you see it being applied using stablecoin as an example?
Can you come again? Sorry.
If Chris is right that the current tokenized value proposition is stablecoins, how do you see that growing and scaling in the cash management space?
Yeah, I think it's definitely a benefit. So basically, when you issue stable coins, you don't hold dollars, right? You invest in something, and it's very. I mean, like, probably Tether could very easily convert that into physical dollar and put that into treasury. But we see a lot of smaller issuers. They have problem accessing that traditional market. So once they issue their like stable coins, they would just purchase on-chain version, also regulated on-chain version of of the treasury management stuff. And also, I think it's moving more and more on-chain, because if your customers are on-chain, like using your stablecoins on-chain, like why not just manage the whole manage the whole thing on-chain, so that you have instant liquidity when people want to redeem or something.
I mean, Neil, we use it now, right? JP Morgan, we use Connexus. It's public information. We've got 13 offices, and we trade something like $40 billion a day. So we end up with balances in all currencies because we trade all markets. At the end of each day, we go to JPM, flick a switch, it auto redeems everything against a single token. There's no costs. And it sweeps everything in one token back to the UK for us, and we hedge it into sterling as a UK company. It's just eradicated 4 jobs. There's no money in it for JPM, but it works brilliantly. And it's a brilliant use of treasury management for every CFO in the world.
Lainey?
Yeah, very quick one. So for Partisia Foundation, we actually work with humanitarian aid organizations, and they're using stablecoins to do transfer from tokens to stablecoins to goods. So basically saying you're protecting the privacy of the beneficiaries, getting water, food supplies, things like that. The vendors or the merchants, they receive the tokens, swap it into stablecoins, cash it out at MoneyGram, Western Union. That's a use case right there.
Well, I think we're officially out of time. It's a fascinating conversation and a really fascinating area. So if you could please thank our panelists today for their contribution. Thank you.